Department of Finance, we have Assistant Secretary Carlo Fermin S. Adriano and Director Maria Carla Espinosa. From NTRC, we have Ms. Monica Girimpilio and Mr. Donaldo Mboo. From the Securities and Exchange Commission, we have Attorney Ferdino Logi S. Santiago. From the Bureau of Internal Revenue, we have Attorney Edgar Alan Reyes. From the Tax Management Association of the Philippines Incorporated, we have Attorney Karine La Forteza and Attorney Crescencio Meneses. From the MAP, we have Ms. Yuni Marie J. Mata Perez. From the Trust Officers Association of the Philippines, we have Attorney Christian Alonzo Velasco, Maria Giselle Lee Beltran, and Attorney Eric Recalde. From the Philippine Insurers and Reinsurers Association, we have Mr. Michael Reliosa. From the Philippine Stock Exchange, we have Attorney Roel A. Refran and Attorney Veronica Del Rosario. From MaxiCare, we have Mr. Christian Argos. That would be all, Your Honor.
Thank you, Comsec. And once again, thank you very much for joining us today. Today, we will be tackling House Bill number 9277. And the title of this measure is an act amending sections 22, 24, 25, 121, 127, 184, 185, and 190 of Republic Act number 8424, otherwise known as the Internal Revenue Code of 1997 as amended. Just as a background, I know that we have been talking about PIFITA for the last many months. In fact, we conducted several hearings, a lot of technical working groups, and then after that, we conducted what we call small group consultative sessions because PIFITA contains many different sectors, such as the banking sector, the insurance sector, equities and debt sector. So, in order to drill down on very specific details of the proposal, we conducted several what we call small group consultative meetings. But we also understand that the LEDAC, which is the Legislative Executive Development Advisory Council, released their new set of priority measures, which included what we now call as, or what we know as CEMEPA. The long title of that is Capital Markets Efficiency Promotions Act. And internally, we call this the small PIFITA. Basically, the direction of this measure is to promote the capital markets, to deepen the capital markets, to broaden the capital markets, and to promote the capital markets. And this is a new proposal that we received from the LEDAC. And that's why this is a carve out from the original PIFITA proposal. And I also consulted the Senate President Cheese Escudero about these two proposals, because on hand, we have two proposals. The original PIFITA, which was transmitted to us November 15 of 2022, and then CEMEPA, which was transmitted to us March 6, 2024. So we have two proposals right now, and we understand that the LEDAC is endorsing CEMEPA instead of PIFITA. But we want to be guided by the Department of Finance, being the lead agency in these two measures. We want to get a clear signal from ASEC Adriano, who's representing Secretary Recto, because we all, as we all know, we all spend so much time discussing, debating, fighting, cursing, abhorring one another, in order to produce a very complete but obviously very productive measure that will help that will reform passive income and the financial intermediary sector. But we want to be guided from the Department of Finance as to this new track. And from what I understand from our counterpart in the lower house, headed by Congressman Joey, the reason why they carved out the capital markets is to deepen and broaden the capital markets. So we for the last month we studied very carefully these two measures, and we feel that there is good wisdom in carving out capital markets, so we can drill down and discuss in depth the promotions of capital markets, and later on we have some proposals that we want to propose to the body and get your opinion on this. But the most basic, I think the most basic question that we need to ask is the DOF endorsing CEMEPA instead of PIFITA? No? And this is a basic question that we want to hear from the DOF, because I understand last week you had a session with STSRO and our team that and then the position paper that you sent us still included all the items in PIFITA. No, so in other words, it's a divergence from the LEDAC proposal. So we again, no, I think first things first is to understand and to get a clear signal from the DOF. Is CEMEPA the new track right now? And if you ask me, you know, kung ako tatanungin personally, I would prefer discussing CEMEPA in the next few months for two reasons. One, it's an easier bill to discuss because the components are only few and interrelated. And I think we can, having a smaller bill means that we can discuss in depth the components of that bill, and obviously we can drill down to a lot of the details and improve on the details. And second is we can pass easily a smaller bill compared to a bigger bill. No, a bigger bill normally takes months to pass, no, because the senators will have a lot of concerns and a lot of clarificatory questions on a bigger bill. So, but then again, if we backtrack a bit, we've spent so much time on PIFITA, and I think we have already completed the discussion on that bill as well. No? But personally, I am, if you ask me, my option will be to discuss CEMEPA and to push forward with that, because I'm very optimistic. Even with the budget, we can no, optimistically approve CEMEPA or get CEMEPA approved before end of the year. No, optimistically, because it's a smaller bill and easier to explain to the senators. So with that opening statement, I would like to hear from ASEC your comments. I think we have to settle first the basic question of which one to prioritize. Both bills were submitted to us already by Congress. In fact, this is the first time I'm encountered that two bills of almost similar nature were transmitted to the Senate. In effect, sinasabi ng Congress, bahala na yung Senado kung ano yung gusto nyo. No? So both bills are very important to the sector, and that's why I want to get an alignment with DOF first before we move forward. So ASEC, I think we should discuss that question first before we go into the details of CEMEPA.
Thank you, Mr. Chair. Good morning, everyone. So the Department of Finance recognizes the intent of the proposed CEMEPA, but we are already pursuing similar objectives through the passive income and financial intermediary taxation, or PIFITA, or what we call now package 4 proposal. And we believe that PIFITA represents a more comprehensive and balanced approach to tax reform, as it addresses systemic issues, promote fairness, and ensure uniformity and fiscal sustainability while encouraging investment and economic growth. We also further note that the main items with regards to capital market promotion are also already in the PIFITA. In fact, in the DOF version of the package 4, we are okay now with reducing the stock transaction tax from 0.6 to 0.1%. So there's no more gradual decline. It will be one instant decline from 0.6 to 0.1. And also in package 4, we also have the reduction in the DST for the non-life insurance. And then also for the dividends, we are okay with reducing the dividends, particularly for non-residents, which is also covered by CIMEPA. Furthermore, we also note that CIMEPA will have a revenue implication of around 140 billion pesos from 2025 to 2028. On the other hand, the DOF package for proposal will generate 10.8 billion pesos positive from 2025 to 2028. Given that currently we're still in a tight fiscal position, we hope that we could push for package 4 instead of CIMEPA, especially that many of the capital market provisions in CIMEPA are also found in the package 4.
CEMEPA is really a carve out of PIFITA. It carved out the equities portion, the debt portion. Actually, only the equities portion. It's in CEMEPA. But the Senate proposal is to include the debt sector, which is bonds and debentures, and also include the entire insurance industry, life, non-life, and pre-need, because it's interconnected to capital markets. So that's the Senate proposal for CEMEPA. But right now, USEC DOF is endorsing PIFITA, which is package 4. No? Sigurado na ba yan? Because iba sa LEDAC. And then before I came here, I double-checked the LEDAC proposal, and the LEDAC proposal endorsed CEMEPA instead of PIFITA. So, I don't want to waste the time of everyone here, especially our resource person who have really given a lot of their time in formulating PIFITA. In fact, before CEMEPA was transmitted to us, I was lobbying to push for PIFITA already because we spent so much time. But we had to change track because obviously we're also getting signals from the LEDAC, which is the coordinating group within the executive and the legislative. So once again, is the DOF 1,000,000% definite with PIFITA? Wala nang urungan to because it's going to be we're actually running against time. By February of next year, it will be campaign season already. And this year, once we go back, kailan man tayo babalik? November. We have only 2 weeks before we enter into the budget deliberation mode. So we're talking about more or less probably 1 month of session deliberations. So the reason why Senator Escudero endorsed CEMEPA is because of the time element. He wanted to get at least half of that big PIFITA approved. But we're also getting signals from LEDAC, which the DOF is also part of.
Mr. Chair, we're okay working with CIMEPA, but our main concern is the revenue. As long as if we can make it at the minimum revenue neutral, CIMEPA, because currently it's 140 billion pesos from 2025 to 2028. So it's just too big in terms of revenue implications. 140 billion pesos. Negative.
Includes the pickup trucks.
No,
Baka pag in-include natin pickup trucks, positive.
we also tried doing those. So we tried to insert provisions in package 4 that are positive, basically gives us positive revenues, significant positive revenues, including the GRTs, the 5% on financial intermediaries and excise tax on pickups. But it's still not enough to counter the revenue negative of CIMEPA.
So even though we add even though we include the pickup trucks or remove the
Yes.
Exemption, it will not reach a positive revenue collection.
Yes, Mr. Chair. For instance, the excise tax on pickups will only generate around 7.5 billion a year. So that's around 30 billion a year. But as I mentioned earlier, the negative implication of CIMEPA in terms of revenue is 140 billion. So we still have a 110 billion deficit, quote unquote. Now, if you add the financial intermediaries, that's around 9 billion every year. So that will generate around 36 billion from 2025 to 2028. So 110 billion minus another plus 36, it's still around, you still have a deficit of around 80 billion negative. However, we also would like to note that I think the major revenue eroding provision in the CIMEPA is the non-life insurance, wherein the DST on non-life given the CIMEPA is maximum of 200 pesos, which is similar to life right now. In the current taxation for non-life for the DST is 12.5%. So that's a very big difference from 200 pesos versus 12.5% DST. So given that 200 pesos DST for non-life, it's around almost 18 billion every year negative. So that's the biggest negative revenue implication of CIMEPA, higher than the STT. The STT from 0.6 to 0.1 is around 7.5 billion negative every year. But we're willing to work with your office, Senmin. Our main concern only really is the revenue implication of CIMEPA. But if we can make it at least at the minimum revenue neutral, I think that's the only ask of the Department of Finance.
You said ASEC PIFITA will yield to how much is that?
The DOF version of the package 4 as transmitted to your office from 2025 to 2028, positive 10.76 billion.
From 2025 to 2028.
Yes.
So almost neutral siya. In
Yes.
other words, almost
neutral.
neutral.
And the revised package 4 of the DOF already considered the proposals in CIMEPA, which include the STT from 0.6 to 0.1, the reduction in non-life, but there's also a reform for the life insurance in terms of DST, etc. So we have here, Mr. Chair, the House Bill 4339, which is the package 4 or the PIFITA of the lower house. And then HB 9277, which is the CIMEPA. And then you have the DOF proposal, which is the revised package 4 of the Department of Finance. We also would like to note that in House Bill 9277, we haven't included the impact of the horse racing, because in the CIMEPA, there's also a proposal to decrease the DST on horse racing, July, if I'm not mistaken. Those are not yet included. So that 140 billion is the minimum, negative 140 billion.
In the Senate version, we did include the Philippine Charity Sweepstakes and the horse racing. We just focused purely on capital markets. And the three components of capital markets will be everything related to equities, everything related to debt, including bonds, and everything related to insurance. And then we added the pickups just to counter the potential revenue erosion of that proposal. Let's do this na lang, ASEC. So in other words, the DOF is also amendable to CIMEPA as long as it's revenue positive or at least neutral.
Yes, Mr. Chair.
Okay. Then we need to find out we need to do some arrangement in the timing of the tweaking of the rates. I think it's a timing that's also important.
Yes, Mr. Chair, but the rates that we submitted to your office is basically the refined package for of the DOF. We haven't provided a counter proposal yet for CIMEPA.
Let's do this for the discussion for today. We'll pursue um, House Bill number 9277. It's not written here, no. The short title is not written in the bill, but informally we call it CEMEPA, Capital Markets Efficiency Promotions Act. And the House version contains actually the reduction in stock transaction tax. It also contained reduction in the Philippine Charity Sweepstakes, DST, as well as horse racing. So that's the main components of this bill. But we can let's do this. Let's discuss CEMEPA for today's hearing, and then after that, I think it will be just a matter of coming up with rates that will not result to revenue erosion, or at least it will result to revenue neutral. And we'll discuss the timing of the rates and also the rates itself as we go along negotiating on the rates, because it's really a big negotiation as we finalize the bill. So we'll just talk about the concepts and the components of this bill, and then so that we will hear from our source person what are the important components that we should include in order to broaden, to deepen, and to promote capital markets. I think the ultimate goal of House Bill number 9277 is to promote capital markets. So that's what we want to get the opinion of our resource persons today. And let's do that muna, Asek, and then later on, as we move along the bill, we'll discuss how to tweak the rates in order to reach the revenue neutral stage. Okay ba yan?
Yes, Mr.
Is that
Chair.
that? Okay. All right. So with that, we'd like to
Mr. Chair,
go ahead, attorney.
may I ask the DOF,
Yeah, go ahead po.
what will make it positive? Meaning, what are the components of BIFITA? Of course, we understand the DOF's concern, and we also hear the senator's statement to make it to push for a simpler bill. So maybe the question is, assuming we push for a simpler bill, what should be added to this bill to make it positive?
There are two main positive provisions under the package for DOF version. One is the tax on financial intermediaries, wherein everything will be at 5%. So that one will generate ₱31.82 billion from 2025 to 2028. The second main positive revenue provision under the package for DOF version is the excise tax on pickups, which will generate another 30 billion from 2025 to 2028. Those are the two main ones. So those two will generate around 60 billion pesos from 2025 to 2028. Compare that to the negative 140 billion of CIMEPA. So we still have a balance of around 80 billion pesos negative, even with the addition of those two positive provisions under the DOF version of package 4.
Can we have the table flashed again?
Yes,
The
I
table
can,
comparing the two bills.
Mr. Chair. Is it possible to present the presentation so we can have a
We'll do that. In fact, DOF made a presentation so that these are an offshoot of our long discussions on PIFITA, and they made some refinements and came back to us. So just to update everyone and to put everyone on the same page, will allow DOF to make their presentation and then later on focus on the revenue aspect.
Thank you, Mr. Chair. Can we go to the first slide? First, so similar as before, the goal of the package 4 is to make it simpler, fairer, more efficient, ensure progressivity, and again, last one is to ensure that it's revenue neutral. Next slide. So the following slides will provide a comparison of the House Bill 4339, which is the PIFITA version of the lower house, House Bill 9227, which is SIMEPA, and then the DOF proposal of package 4. So for the first item, which is interest income, the DOF proposal is everything at 20%. This is in comparison to our previous proposal, which is to reduce it to 15% gradually. So we're now adopting the House Bill 4339 version with regards to interest income. And as you can see there, we provided the revenue implication from 2025 to 2028 per each item. So for SIMEPA, for interest income, there's nothing for savings deposit, time deposits, FCDUs. Next slide, please. And so these are the other items for interest income. So all at 20%. Next slide. And then for royalties, DF proposal is same as tax code, so there will be no difference. This is a departure from the previous proposal of decreasing gradually the royalties from 20 to 15%. We also note that for SIMEPA, there's no provision on royalties. For prizes and other winnings, again, no decline, same as tax code. We retain what is written in the tax code. Next slide. This one is the one with SIMEPA provision, the PCSO winnings. So for under the DOF proposal, same as tax code. So I think 20% if greater than 10 peso, 10,000 pesos yung winnings. Under the SIMEPA, reduction from 20 to 10% final tax on winnings above 10,000 pesos. So that will be around 6 billion pesos negative from 2025 to 2028. Now for the dividend income, SIMEPA, basically there's a reform there to decrease the dividend income for non-resident from 20 or 25 to 10%. The DOF proposal is 15% for non-resident, which is equivalent to international tax treaties at 15. So relatively minor revenue implication. Next slide. And then this one is a transaction tax. This is the provision with which is related to the capital market formation. So under the DOF revised proposal, we are okay now to reduce stock transaction tax from 0.6 to 0.1%. Before, we wanted a gradual decrease, but now we're going to propose one big time decline from 0.6 to 0.1%. And we note that the revenue implication of this from 2025 to 2028 is around negative 30 billion. It's already similar to the SIMEPA proposal. Next slide. This one are the tax on financial intermediaries. This is the making it all to 5%. Currently, it's 1, 3, or 5. So given this proposal, this is the one I mentioned earlier, one of the biggest positive gains under the package 4 of the DOF proposal, which will generate 31.82 billion pesos. We note that in SIMEPA, there's no such provision. They only have a removal of derivatives from the coverage of the 7% GRT. which is a minor decline of around 0.06 billion pesos from 2025 to 2028. Next slide. So we also have here for the HMOs, instead of VAT, under the DOF proposal, it's a 2% premium tax. Next slide. And then this is the excise tax on pickups. Again, under the CIMEPA, there's no such provision, equivalent provision. This will generate around 30 billion from 2025 to 2028. Again, one of the biggest positive revenues under the DOF package for proposal. Next slide. Then the last items are with regards to DSTs. So the first one, which is also related to capital market, which is the original issue of certificate of stocks. Currently, this one is at 1%. We are reducing it to 0.75%, and it will generate negative 7.1 billion revenue forgone from 2025 to 2028. There's no such equivalent provision under CIMEPA. So ito Mr. Chair, isa pa sa mga related to capital market. And then the others, almost the same. It's just in ad valorem. Next slide. Not much here. Next slide. So we remove all bills of exchange or draft. And then others just ad valorem, translated to ad valorem. Next slide. For the life insurance under the DOF package 4, so those that are pre-need will pay the same DST as life insurance. So that's maximum of 200 pesos. So this is also related to, and under the CIMEPA, there is no equivalent provision. Now, the item 11, which is the policies of insurance, this is the non-life. So again, under the CIMEPA, it will have a DST similar to life, which is a maximum of 200 pesos. And it will generate revenue forgone of around 65.6 billion pesos from 2025 to 2028. Under the DOFP for proposal, we're proposing to reduce the rate from 12.5%, which is the current rate, down to 10%. So that will generate a revenue forgone of around 13 billion from 2025 to 2028. So that's the biggest difference for the non-life. It's the rate. CIMEPA, maximum 200 pesos. P4, it's 10%. Next slide. Item number 12 is also related to non-life. So similar, CIMEPA, maximum 200 pesos. DOFP for proposal is 10%. From 12.5%, it will become 10%. So again, the revenue forgone is, the difference in the revenue forgone between CIMEPA and DOF is significant. So 6 billion under CIMEPA, 1.2 billion only for DOF proposal. Then policies of annuities and pre-need, again, under the DOF proposal, this will now be treated as life, similar to life. Next slide. Indemnity bonds, no change here. Next slide. Certificates, DST on certificates, we're proposing to remove it under the package for proposal, DOF. Next slide. So we don't have yet an estimate for the July horse racing tickets, but we note that under the CIMEPA, there is a proposal to, is it remove? Lower the DST on July horse racing tickets. Now for the PCSO DST under the CIMEPA, the proposal is to lower it down from 20 to 10%. Under the DOF proposal, the proposal is from 20 to 15%. So the difference in revenue forgone is around 16 billion. So under CIMEPA, it's 32.2 billion. DOF proposal is 16.1 billion negative. Next slide. And then proxies for voting, powers of attorney remove in the DOF proposal. Next slide. And then not much here. Next slide. And then this is the summary. So this is the comparison of the major items. So for the tax on passive income, the DOFP for proposal is positive 15.7 because as I mentioned, the proposal now is 20%. Unity at 20%. And then for the House bill, it's negative 36.2. It's because of the stock transaction tax, mainly from the stock transaction tax. But I would like to note in the DOFP for proposal, as I mentioned earlier, we are also reducing the SDT from 0.6 to 0.1 already, but will still generate positive revenues given the other reforms in the passive income items. And then financial intermediaries, as I mentioned earlier, this is the 5% uniform rate, 31.8 billion from 2025 to 2028. And then DST for CIMEPA, it's negative 103.8 billion. Biggest item here will be the DST on non-life at around 18 billion negative each year. And then for the DOF proposal, DST, it's around negative 40.7 billion from 2025 to 2028. Then lastly, excise tax on pickups, positive 30 billion from 2025 to 2028. Given this, as you can see, the total of CIMEPA is again negative 140.1 billion from 2025 to 2028. For the DOFT for proposal, it's positive 10.76 billion pesos. And then I will not discuss the other slides. I will end here, Mr. Chair.
Thank you. House Bill 9277 is the proposal from the House, but we made some modifications in the last few weeks. For example, I'll give you a case in point. Can you flash on the slide, Comsec, yung PCSO Lotto? Kasi in the House, they included PCSO Lotto, which is about negative 32. Saan yan? Next one pa. Next one pa. There. So we didn't include this. This is right away 72 billion pesos of the revenue. And my view is, buying lotto tickets is inelastic. It's a function of the price, of the cash price. So even though the DST is at 20%, people will still buy the tickets because they want to win the cash price. For me, buying lotto tickets is inelastic, in a function of the price. So i-add back mo na kaagad in 32. And in the Senate version, we also added the pickups. And pickups is about, can you go to the slide on pickups? It's about 30 billion. Go to the pickups. Yan, it's already 30 billion. Go back. So 30 billion na siya. So sa Senate version, you will now gain 62 billion. Correct? So if kung hinahabol natin is 140, 62 is already add back. So 78 billion na lang. So sa Senate version, nakakahabol tayo. Asek, diba? So maghanap pa tayo dito ng konti, makakahabol pa tayo, baka mag-revenue neutral na ito. So that's why we along the way we were studying what we can include so that the goal is just to be revenue neutral, but the double goal is revenue neutral and promote capital markets. That is the goal, no? So that's why we're modifying the rates along the way. But just to share to the body that in the Senate version, we can already remove 62 billion from the 142 billion revenue negative. No? Attorney Meneses?
Good morning, Mr. Chair. Just to make a point of clarification in the numbers presented by the DOF, the summary, if we can look at the summary numbers, yung buo na 140 as compared to 10 billion. Yeah, the comparative table. Yung
The very last table, ano?
yung first
Comsec.
table, yung comparative lang, yung summary lang.
Comsec. Go to that slide.
Yan.
Yeah.
Kasi we noticed that there's a difference in the tax impact under HB 9277 for the STT. Yeah, di ba? Tax on hindi. DST. Tax on tax on financial intermediaries, DST, of 103 billion, but in the DOF proposal, it's just 40 billion negative. What's the difference, sir, ASEC, about the two numbers? Why is it that in the DOF proposal it's just negative 40.75 billion and in the HB 9277 it's 103 billion? Kasi yun yung pinakamalaki na impact.
Thank you for that question. So, number one difference is yung policies on non-life, basically DST, particularly policies of insurance upon property, which is Section 184 of the tax code. Under the CIMEPA, the proposal is depending on the amount of insurance, exempt, not exceeding 100,000, and then if exceeding 1 million, maximum of 200 pesos, similar to the DST taxation of life. So technically, a maximum DST for non-life will now be 200 pesos compared to the current rate, which is 12.5%. The proposal of the DOF in general for non-life insurance DST is to reduce from 12.5% to 10%. So the difference in that revenue forgone, for instance, for Section 184, under CIMEPA, it's 65.6 billion pesos negative. Under the DOF proposal, it's only negative 13.1 billion. So that's a difference of more or less 50 billion pesos. And then for Section 185, which is fidelity bonds and other insurance policies, which is also a non-life DST, again, maximum 200 pesos under the CIMEPA. DOF proposal is reduce it from 12.5 to 10%. Revenue forgone under CIMEPA for Section 185 is negative 6 billion. Compare that to the DOF proposal of negative 1.2 billion. So technically, if you add those all up for the non-life, it's around 71. It's around 57 billion pesos difference in revenue forgone for CIMEPA and DOF package for non-life DST. So that can almost explain that whole difference of 103 and 40 billion difference. And then the other difference is the PCSO DST. Again, under the package for proposal of the DOF, it's a compromise for in consideration of CIMEPA. So our proposal is to decrease DST from 20 to 15% for PCSO lotto tickets. That's negative 16 billion. For CIMEPA, the proposal is from 20 to 10%. That's negative 32.2 billion. So a difference of around 16 billion pesos. So those two items can explain majority of the difference of the DST under CIMEPA and the DOF proposal. It's basically 57 from the non-life plus another 16 from PCSO. That's already 73 billion difference.
In PCSO kasi, ASEC is one pocket to the other pocket eh. To be honest. Diba? The DST goes to government as well. So I think for our purpose, in my opinion, since government will both whether PCSO or DOF or BIR, it's government that will gain from the existing rates. So that's why we didn't include PCSO because in our view it's the same pocket anyways.
We understand, Mr. Chair, but again, the consideration here for the DOF is in consideration of the CIMEPA. It's a compromise.
I get your
Mr. Chair, one more point that I forgot to make, that under the package for proposal of the DOF, we still include the automatic exchange of information provision.
And in ano ni Attorney Nina, that's her baby. Any more comment, Attorney Meneses? Kasi yung I think if you look at the breakdown, the PCSO alone is 5 billion plus 32. It's already close to 40 billion eh. Because they also adjusted the winnings, which is 5 billion from 20 to 10%.
And then, Mr. Chair, maybe if I think someone will ask later, can we go back to the previous slide? We also included a prospectivity estimate. As you can see in the House Bill 4339 and DOF proposal, we have a prospectivity assumption here. As we all know, the implementation of this will be prospective, meaning those, for instance, for interest income, those that was able to have a contract before P4, for instance, it's a long-term contract, which is subject to 0% preferential rate. The assumption there is that they will still be able to avail of that 0% tax rate until it expires. So we have that prospectivity assumption because when we computed the revenues, it's basically the assumption is all contracts will now transfer to the new rate. And hence we have to do a prospectivity deduction. But under the House Bill, we do not have yet a prospectivity assumption. So again, the 140 billion there is at the minimum. It can be higher.
Let's do this, Asek, since we're discussing CEMEPA today, and we still have the LEDAC list of bills that included CEMEPA, so that we can have this discussion on CEMEPA. Let's talk about it today, no? So that we can hear from our source persons their opinion on CEMEPA, and then later on after the hearing, we will have to work or tweak the components of CEMEPA so that we will reach that negative or that revenue neutral state, and then at the same time propose capital markets. And I do agree. Now, and I'll show later on, there's so many literatures already saying that a deep and vibrant capital markets lead to economic growth, you know, and capital available to corporations will be reinvested to contribute to productive means and also contribute to our economic growth. So we support that concept, and today we'll talk about CEMEPA, and then we'll also ask our resource person some of the concepts that we included in the bill, and then we want to hear their opinion on those concepts. All right. So, Asak, do you have any particular comments on CEMEPA alone, aside from what we have discussed on the revenue potential?
Mr. Chair, I don't have anything to add. But again, we just would like to note that most of the provision with regards to capital market formation in the CEMEPA are also included in the package 4.
Understand that. It's just a matter of, I guess, on which one can we get approved as quick as possible, considering that we have only a few days left before the 19th Congress end. We have the campaign period to contend with. We also have the budget deliberation to contend with. All in all, that will take from now on till May. If you include the campaign period and budget deliberation, that's already 4 months to 5 months off the calendar. No, so we have to be realistic on how to approach this. But we're not removing PIFITA. We'll consult later on with our leaders, just to put everything. That's to put everyone on the same page on CEMEPA, and we want to get their opinion. We'll discuss that today, so that we'll get their comments. All right. So with that in mind, we'll ask our resource persons their opinion on the bill. And I understand that you have been furnished with House Bill number 9277. Again, the direction of this is to develop our capital markets and to promote our capital markets. We'll start off with PSE, Philippine Stock Exchange, because in the bill, there's a recommendation to lower down stock transaction tax. And we want to hear your opinion on that. And what else can we include in the bill in order to promote the capital markets in the Philippines? So we'll call on Attorney Refran of the PSE. Yeah.
Good morning, Mr. Chair, members of the committee, as well as the resource persons. Mr. Chair, at the onset, maybe I'll just also share our views. When you say capital markets, it actually has different pillars. No? And particular to the CEMEPA, it touches on the secondary market. Because when you look at any capital market transactions, theoretically, technically, globally, a fundraising exercise. So now you deal with the primary fundraising component, which under our current tax laws has actually already been reduced. We removed the IPO tax. Primary issuance, I think from what DOF mentioned, will also hopefully go down from 1% to 75 basis points. So that's on the primary market side. But I think what CEMEPA primarily deals with when you look at competitiveness, efficiency, is on the secondary market side. And I would like to share with the committee, when you look at the secondary markets, on a good day, we have around $100 million by way of value traded or value created in our market on a daily basis. And this is in the equities market, Mr. Chair. If you go to the bond markets, theoretically, Mr. Chair, as well as in practice, bond instruments are not actively traded, corporate bond, except for government securities, especially when the yield curve shifts, as we saw 3 weeks ago with a 50 basis points shift. The yield curve in the Philippines from 6% for 10 years went all the way down to 5.6%. And we see that to be moving with volatility and all in the bond market. So that's an occasion for holders of government securities, primarily institutionals, to actually see whether they would want to refinance and see if there are takers in the bond markets. But essentially, that's an over-the-counter transaction, although there is a bond market for that. If you pour through the discussions in CEMEPA, Mr. Chair, it's really incentivizing the participants globally, as well as the local participants, to consider investing in the stock market. And this paves for the way for the churn or the domestic activity, because right now, compared to Vietnam, for example, Vietnam's doing around 800 million to around $1 billion a day, Mr. Chair. That's one day. And Vietnam, in terms of the listed universe, primarily an SOE, state-owned enterprises market. So if you look at the dynamics of the Philippines and Vietnam, and I didn't think I would compare the Philippines to Vietnam back 10, 20 years ago, but we're here. Although we are now sovereign grade rating beginning 2013, 2014, for that 11 to 12-year period, we have not seen the influx of investments abroad, primarily because of the high friction cost when it comes to the secondary market, Mr. Chair. So I go back to what I said earlier, when you look at capital markets, it's one thing to get them to come in. It's another to get them also to invest more, because they know when they come in, they can exit at a good multiple. And we've seen this time and time again in the capital markets, both for the institutionals, let's say the sovereign wealth funds, Mr. Chair. Normally, the most active are Aran Capital, the Sovereign Wealth Fund of Singapore, and a lot of the European funds. But they are now thinking of, it's a very costly market to allocate resources to, not only because with 100 million daily activity, that's just too much work for a lot of participants, Mr. Chair. So tying up all those concepts, the moment we're able to reduce from 60 basis to 10 basis points the transaction tax, we're now going into a territory where we've seen in other markets, like the most comparable, Mr. Chair, is what the Taiwan Stock Exchange did. They used to have 30 basis points, and they have that to 15 basis points. And globally, when you look at Taiwan today, they are an inspiration for a lot of the fund managers. Their ETF scene has really boosted because of more than 150 ETFs, Mr. Chair. We only have one ETF. Because in ETF, the creation redemption process deals a lot with the friction cost. No? And it's not just the primary, but also the market making activities, which partakes of a secondary market, Mr. Chair. So in the case of Taiwan, their multiplier in terms of average daily volume increased by 3.3% over a 5-year period. Of course, it's not immediate, but over a 5-year period, Mr. Chair, the revenue losses they were able to recoup primarily because not only did their market value increase, but the attention that they got from the foreign, but more especially the domestic. Out of the 22 million Taiwanese population, Mr. Chair, more than half are actually investing now. And when we have our dialogue with our peer exchanges, Taiwan has 2 exchanges, a Taipei exchange, the Taiwan Stock Exchange. It's really the transaction task that they saw to be a big pivot in their market. No? So going back home, we're also doing a lot of retail participation activities via, let's say, the e-wallet or online mobile platforms, Mr. Chair, whether that's Maya or GCash. So the goal is really to bring down on the cost basis and the entry point for a lot of our investors domestic. If they could invest for 100 pesos, then that would be a sweet spot for the Philippines, Mr. Chair, just to get them to remove the thought process from, going from the quick rich scheme, get rich quick scheme, or our view, for example, Mr. Chair, we talk about securities. That's sensitive because a lot of them like to go into the Bitcoins and all of those, no? Which for us, in terms of gatekeeping, in terms of capital markets, would not fall under the term securities. So, Mr. Chair, when you look at capital market efficiency, there's a lot of moving parts, but CIMEPA addresses a very salient and a very clear impediment for development, which is the tax on the secondary market. At 60 basis point, nowhere else in the world do we have a 60 basis point presumed gain because it's a transaction tax on secondary market activity. And I think when you look at the overall development of the capital markets today, as we are working with our regulator, the Securities and Exchange Commission, to develop a derivatives market, Mr. Chair, these are the more important components of a capital market activity for the foreign and the domestic to participate. If they don't want the cash market, which is the bonds or the equities, they have an option to go into the futures contract. They have an option, at the very least, either they want to go long or whatever trading strategy in the futures. And that brings down the friction, the entry points, Mr. Chair. So we are very hopeful that when you look at CIMEPA, we see it for what it is. It's a capital market efficiency activity. Because the other components of CIMEPA currently are not, they're technically in the capital markets because they're not securities. Capital markets, Mr. Chair, fundraising, and the secondary activity dealing with securities under Republic Act 8799 or the Securities Regulation Code. There are a lot of laws that are indeed participants in the capital markets, but to say that they're also probably, as mentioned by Mr. Chair, given the time constraint, it might be a good quick win. And I believe the DOF also sees the urgency, and the LEDAC probably shares that view, Mr. Chair. And this early, Mr. Chair, as a final point, there are a lot of other securities financing transactions that would revolve heavily on the base friction cost, because in the multiplier effect is not just on the secondary trading. Globally, investment banks as well as other institutions would like to take positions where they can hedge, and then that's going long on any investment. They want to hedge their exposure. And so in our space, when you look at capital market development, if we could allow them to hedge at a friction cost that would probably compete with, let's say, Hong Kong, Singapore, Mr. Chair, or Thailand for that matter, Mr. Chair, no? Then that actually is a very big narrative, compelling narrative for Philippines Inc. This is not just for PSE, but really it's Philippines Inc., Mr. Chair. And we believe this is really a long-awaited implementation or efficiency measure. Hopefully, Mr. Chair, with our investment grade rating still stable. In fact, we got an upgrade from a Japanese rating agency early on this year. And we also see the government reaping the rewards, Mr. Chair, in the bond markets. When they are pushing for sustainability bonds, I think the spreads were very tight when you look at the pricing finally of the 25-year government bonds, as well as the 10-year government bonds. So this is the activity, Mr. Chair, that we're seeing having a ripple effect because it impacts the jurisdiction itself on a sovereign rating basis, as well as the other components of the capital markets, particular to the bond markets and the equities market, Mr. Chair. Thank you,
Thank
Mr.
you, Attorney, for that comment. In the proposal, in the SEMEPA proposal, it proposed to reduce stock transaction tax. Is that enough already to promote capital markets, particularly equities? Let's
Right,
talk
Mr.
about
Chair.
equities first. Based on your experience, is that enough to
It's
boost the equities market?
Mr. Chair, it's going to be a very big push in terms of especially the big funds considering the Philippines for purposes of allocating their capital on a daily basis, Mr. Chair. It's not 100% silver bullet because there are a lot of other incentives being provided by foreign jurisdictions when it comes to, let's say, exchange-traded funds, Mr. Chair, because the concept of an ETF, while it's structured as a corporation, it actually tracks the payoff mechanism of an underlying asset. It's theoretically a derivative, and when it's traded, it's primarily for purposes of providing, let's say, the market makers enough incentive because it provides liquidity, Mr. Chair. So you want the Filipinos to think of the market as a market for them to be financially independent on a long-term basis. And ETF should be first and top of mind for them, other than, let's say, an REIT that we have right now, Real Estate Investment Trust. Also with yields going from 6 to 7%, Mr. Chair, on a year-on-year basis, pursuant to Republic Act 9856, I don't think that's an instrument that Filipinos should just gloss over. Where you look at the bond markets are going, as I mentioned earlier, on the government bond, maybe 5.6% on a 10-year basis. So if we'd be more than happy, Mr. Chair, to give others, especially just really to mirror and hopefully it will not be, it will actually be accretive to the revenue efforts of government. Now, we don't want also to further dilute the revenue collection of the government because we are now targeting these instruments where there is no activity. As I mentioned, Mr. Chair, we only have one exchange-traded fund, and that is the FMETF, launched back in 2014, 10 years ago. 10 years later, we're still where we are at, for that instrument. There's no liquidity, Mr. Chair. Any given day, probably would get liquidity there of anywhere from maybe 5 million pesos, which is nothing, Mr. Chair. We're looking at the market with our domestic market cap, 16 trillion today, Mr. Chair. Almost, together with the foreign, almost approximating our national GDP. So right now, if we provide some other incentives for that, it's actually generate a lot of activity because we're getting 100% of nothing today when you look at the exchange-traded fund. But we are working very closely because this is where a lot of the funds also represented in this hearing would probably be best suited to consider, Mr. Chair. Because us, when we come up with indices, we believe that it has to be tailor-fitted to the asset management industry. If you want high dividend yield, if you want a monthly paying dividend yield. So that's really a very big political message also for the Filipinos. No, it's like they get a second, third job with that. And we believe that ETF market is very powerful, Mr. Chair. So the ETF space, Mr. Chair, if we could also provide for other incentives, no? Because it's, as I mentioned, we have it, we have one, but the experience with that is that although with the documentary stamp tax reduction proposed by the DOF from 100 basis to 75 basis, that's going to also bring it down further in the creation process. It's like a DR, this depository receipt, but this is easier understood from an investing perspective, Mr. Chair. So with the STT reduction, and we'd just like to further clarify that when it comes to exchange traded funds, there might be a sunset provision if they could also enjoy, for example, other benefits, just for purposes of getting the ETFs also off the ground, Mr. Chair. In general, this would allow for a more innovative market because we can come up with a lot more products that we are not inventing, Mr. Chair. I always tell our team that, you know, it's one thing to invent, but you have to speak the same language, and we have to speak the language of finance and the language of business globally. It cannot just be centered on the Philippines, no. Because in the end, Mr. Chair, we're competing against other markets, and as volatile as markets are now, if we see our market at 7,450 today, with a blink of an eye, it can go all the way back to where it was, you know, very low levels, Mr. Chair. So I think we're always 2-3 steps behind, and we really feel the urgency. So our appeal is if we could actually unbundle to the extent that really the capital market securities also get that boost, hopefully sooner, Mr. Chair.
Proposal in the original PIFITA, I'll just show it on the slide. Yung taxes on financial transaction, COMSEC. Original issue of certificate of stocks, sales agreements to sell. In the original PIFITA, there's a proposal to lower it down, no? The DST. Will this also help in the promotion of the equities market?
Definitely, Mr. Chair. Back in
This one, ito. We'll just show it.
and we've seen that, Mr. Chair, when the original issue of DST was halved from 2 pesos to 1 peso for every 200 par. Except that over time that has been restored. So it's now at a level where it was actually double from where it was, which was for the primary issuance, 2 pesos for every 200. We brought it down, Congress brought it down to 1 peso for 200. And then the secondary from 150, it became 75 cents for every 200. But now we're back to square one. So any reduction, Mr. Chair, we've seen this back in mid-2000, beginning 2005, 2006. And the markets really picked up because of that halving of the doc stamp, both on the primary and the secondary. Although in the secondary market, beginning 2009, Congress deemed it best to already remove the DST on the secondary transaction. So definitely, Mr. Chair, on the primary market, that reduction will really bring us also up to speed on the primary issuance, Mr. Chair. And this will be for the original creation of common shares, preferred shares, and other equity-like instruments, Mr. Chair.
Step 1, diba? Original issue of certificate of stock. This is basically, this is IPO, no? So this is step 1. So
Issuance, Mr. Chair.
the issuance. So we're reducing friction costs on step 1.
Oh, definitely, Mr. Chair.
Yeah, all right. And then let me ask ASEC, Carlo, did we factor in, because we're reducing, I think I asked you this last time, because we're reducing friction costs with the hope of expanding the market. In our revenue projections, did we include expanding the market?
For STT, no.
Mm-mm.
We assume that there will be no change. But we would like to note that given the current revenue that we receive from STT, the volume should increase by 5 times.
So, but we haven't factored that in yet.
No.
Okay, and then so that's also another aspect that we can look at, because by reducing it, the hope there, and there's already literature, diba, attorney? There's already literature, if we benchmark it to Taiwan, the growth is
Yes,
tama ba?
Mr. Chair.
3% per annum.
They have seen a 5-year growth rate of more than 6.33%, roughly 6. But the levels at which they are now is still bigger at around more than 3 times compared to prior to. So the 600% increases on the daily volume traded, Mr. Chair, over a 5-year period. And then if you look at their market cap, they've increased by more than 300%. On the totality basis, Mr. Chair. But the churn there is the average daily volume, because that's where government collects. STT is collected at source, Mr. Chair. There are collecting agents embedded based on the BRRR, so that the investors actually don't have to anymore worry themselves with that.
Earlier, also that the Taiwan experience is they reduce stock transaction tax, but because of the increase in volume, they managed to recover it in a short period of time in terms of absolute collections. No?
That's correct, Mr. Chair, because any market that you talk to right now, and you look at, let's say, Taiwan as an asset management company, or the regional brokers, for example, not necessarily the domestic brokers. Regional brokers favor Taiwan right now because of a lot of the ETFs that have been born out of the reduction from 30 basis to 15 basis of their transaction tax, Mr. Chair. Vietnam right now offers a 10 basis point transaction tax. We are the highest at 60 basis point. The other ASEAN markets, Mr. Chair, let's just focus on the six countries in ASEAN: Singapore, Malaysia, Thailand, Vietnam, Indonesia, and the Philippines. Very few, as in fact, only Indonesian Stock Exchange, the Philippine Stock Exchange, and Vietnam would have transaction taxes. So if we could at least bring it down immediately to the level of Vietnam, we pray also that when you look at the multiples in Vietnam, Mr. Chair, we could do 600 million a day, if not a billion a day. Wow, that's really going to open up our country to a lot of, especially in the MSI's Emerging Markets Index, Mr. Chair. The Philippines account for roughly 0.07%. That's very negligible when you look at the other ASEAN countries. And the moment you're in that MSCI EMI index, that's actually the best news for any listed company in the Philippines, because it attracts a lot of the passive funds globally. And a lot of the funds right now are more on the passive funds rather than actively traded funds, save for the private equity, the hedge funds. So because you can't beat the market, that's something that a lot of investors also already appreciate. So if we could get into that narrative, Mr. Chair, and anytime JP Morgan was here 2-3 weeks ago, and we were discussing with them how we could probably more improve the standing of the Philippine market, both on the bond market and the equities market. And the STT is always a point of concern for them, Mr. Chair, because it's really just an expensive market for us right now. And we can turn that around the same way we're seeing probably other countries were very quick on the draw when it came to being more competitive on the friction cost, Mr. Chair.
Thank you, Attorney. I'll jump to a related topic. The role of insurance companies. What is your view on the role of insurance companies to the equities market and your experience in that respect?
So, Mr. Chair, insurance companies are big institutional investors with ultra long-term investment horizons. And we see them participate like the same way pension funds do. Although pension funds right now do a reallocation when it comes to the equities market. I'm not sure if in the investment philosophy in terms of the allocation among asset classes, if insurance companies would also dedicate a lot more for the equities market, because I imagine on a liability matching perspective principle, they want to match liability together with their investments. So this is going to favor heavily on the fixed income markets. Although there might be money left on the table because the returns are being given, especially where yields are going down the bond markets in the equities market. But volatility aside, Mr. Chair, we feel that insurance companies are very active in it comes to fundraising, which is the primary market in terms of the IPO, primarily through also their asset management companies. They do have their own asset management companies for the mutual funds and the UITFs. And some of their products, such as the VOLs, although not defined as securities under the law, are actually tracking a portion of the VOL premium are tracking they're like collective investment schemes, Mr. Chair. Although theoretically they are structured under the revised insurance code as not as securities, but as bank assurance products but we feel that for example, the securities borrowing lending business, this is one of the securities financing transactions that we want to get off the ground, Mr. Chair, to pair with short selling. We launched the short selling initiative, and that cannot work if there's not a lot of securities lending agents. Insurance companies may be natural lenders because of a lot of their idle securities. These idle securities can give them returns if they participate in the lending business. And this is structured already globally, Mr. Chair, and other markets, including Taiwan, by the way, is a very active securities borrowing lending business. And the same with Singapore, the same with Malaysia. So insurance companies for a lot of products may be keen to participate, including the lending agency business, because they're long-only assets. Rather than being idle, they could also participate and earn an income stream or a yield. Maybe on average, Mr. J, it's not going to be a lot depending on the lending term for securities lending, but depending on the security, it could give you at least 1 to 3% on an annual basis compared to nothing, Mr. Chair, on their idle. But on the trading side, I would not imagine them to be very active in the trading space because of their investment horizons, very long only. Although I'm seeing a lot of pension funds, government, as well as private pension funds also realizing that the money being left on the table is something that they could also probably pick up on. But Mr. Chair, the insurance business is very much also a participant primarily in the primary market, not so much in the secondary, for the reasons I mentioned, Mr. Chair.
Do you see, based on your experience and from literature, if we promote the insurance market, meaning improve the penetration rates, get more people to buy insurance and therefore pay premiums, and from what we see in the literature, those premiums end up in the equities market as well as the debt market and other asset classes. But definitely some portion of that will end up in the equities market. Is that the same experience that you are is that the same trend that you are seeing based on your experience?
We have not seen in other markets, Mr. Chair, let's say the situation where we are in right now. But with an increase in the investable funds, the dry powder of these insurance companies would definitely increase. Except that in terms of their investment philosophy, they're being ultra long-term, Mr. Chair. The safest haven assets would probably be on the fixed income space because you don't lose the principal. And depending on the security, maybe the government security or even the highly rated corporate notes would probably be their investment of choice, Mr. Chair. But we do have also REITs that are actually not just on paper, but in reality by law, they're actually bond-like, Mr. Chair, because while there is no assurance that you will get back your principal, there is a guaranteed by law requirement for the yields, because we will delist them if they do not give dividends on a yearly basis. And the beauty for an REIT is they get deductibility for dividends paid, which is not in any other company under our tax laws, Mr. Chair. Only REITs get a deduction for actual dividends declared. So in exchange for their commitment by law, mandated by law, to declare dividends, which is bond-like in essence. So you get 6-7%. Some REITs even return 8-9%, depending on the market price, Mr. Chair. And that's something that really gives a lot of returns to long-only funds, Mr. Chair.
How about the debt market, attorney? I know that the Philippines is still not as vibrant in terms of debt and fixed income, but that also forms part of capital markets.
Definitely, Mr. Chair.
And what's your view on promoting the debt markets in our country? What reforms do we need to undertake in order to the same thing, to deepen it, to broaden it, make it accessible to even ordinary Filipinos?
No, Mr. Chair, when you look at our debt markets, primarily it is a market where for the retail participants, they only get to participate primarily through the asset management companies or the trust companies, simply because the very nature of a debt market of a bond instrument rather is that you buy and hold that instrument. And anytime you want to refinance that because of changes in the yield curve, the normal practice is that I will offer you a replacement. And this happens when a corporation redeems or calls an on-the-run bond instrument. Let's say on the third, fifth year, normally there's a redemption clause. And we buy that back because it's now so expensive for them to continue to pay the interest throughout the term of the loan. Normally there will be another instrument that existing investors can put their money in. So it's really buy and hold. For a lot of the individuals, the Filipinos, they do participate in the bond markets indirectly through, let's say, the mutual funds, whether it's a balance fund or it's a dividend yield fund. But we feel that the digitalization of markets could also allow Filipinos on the secondary markets, which is still a test case, Mr. Chair, because bond markets generally are not very liquid. Only the government securities market, you'd see a lot of liquidity, but because of the tenors and because of the on-the-run securities. But for the corporate notes, it's really buy and hold, unless there's really a major refinancing issue, Mr. Chair. So with the digitalization efforts of a lot of stakeholders for the bond markets and the equities market, that would also probably give them an opportunity to, especially for corporate note issuance on a primary basis. This is like the IPO, but in the bond markets. And this is where we're seeing record highs in the bond market today because of the volatility of the interest rate. They could participate there, Mr. Chair, again, through their brokers. And if that could also be like what we do in the exchange, we allow them to participate online via a mobile app so that they don't fall in line anymore. And they feel that they're also able to participate in these good offerings, Mr. Chair. So bond markets are a much bigger market compared to the equities market. On the secondary basis trading, however, they are not actively traded. But I guess, Mr. Chair, to your point, participation there is when you see them to also be more aware of what it represents compared to, let's say, a preferred share. Because sometimes when you go around, preferred shares are being sold to retail investors. They see the word preferred, but they think of yields, which is theoretically not correct, Mr. Chair, because prefers, although there's a component for dividend, that's not guaranteed. Unlike in the bond markets, come hell or high water, that instrument will pay dividend, will pay coupon. So I guess it's the awareness part. The literacy would also hopefully pick up, Mr. Chair, with the efficiency measures that Congress is now and the Senate would now be tackling, Mr. Chair.
See the need to reduce friction costs as well in the bond market. Do you see the need to so that people can participate, people will be enticed to participate? Do you see the need to reduce friction costs in that market?
Thank you, Mr. Chair. I believe that any reduction in the friction cost, especially for the bond markets and the equities market, would have a multiplier effect, as we have seen in other cases where in the Philippines we did provide for certain incentives for capital market products, Mr. Chair. So that's really the same scenario for the bond markets, because the thought process and the effort required for a lot of the hedge funds who are now very active in ASEAN, Mr. Chair, would also be the same thought process when they look at asset allocation across alternatives within a jurisdiction and across a region and even globally, Mr. Chair. So the same considerations, risk-reward profile, Mr. Chair, of a particular jurisdiction, as well as particular security would be considered. So the payoffs would always be offset against the cost to invest, as well as the ease in which I can exit the liquidity, Mr. Chair, which is not just a function of volume, but a function of time. If you are liquid today, but I need to exit yesterday, you're not liquid. Liquidity is a function of two types, Mr. Chair. Time, how fast can I exit? Can the market absorb? So the absorptive capacity of the market is what we're also growing, both in the bond market and the equities market, Mr. Chair.
Thank you for that, Attorney. Well, I'll jump to another industry, and this is the insurance industry, because in the Senate proposal, although we haven't really released that to the public, we included the insurance industry in the bill because we view that the industry is a vital component in the promotion of the capital markets. In concept, the premiums that are being collected obviously will be invested in different asset classes depending on the need of the insurance company. So we want to get their views on we want to get the views of the insurance industry in relation to the capital markets, because that's the direction that we are pursuing. So we'll call on we'll call on Mr. Michael Relosa of PIRA. Any comments?
Thank you, Mr. Chair. So the Honorable Senator Win Gatchalian and members of the Senate Ways and Means Committee, good morning, everybody, and thank you for having us. I'm Michael Reliosa, the Philippine Insurers and Reinsurers Association, the umbrella organization of the non-life industry in the Philippines. I wish to advise that we have submitted a position paper to the Secretariat, and summarizing the paper, we wish to manifest our full support for House Bill 9277, as it will, if passed, play a crucial role in the continued enhancement of our nation's tax system, aiming for fairness, efficiency, and simplicity. We wish also to highlight our support for the salient portions which impact on the insurance industry, particularly the provisions under sections 184 and 185, which align the documentary stamps on insurance policies on property and fidelity bonds and other insurance policies, aligning it with that of the life insurance industry. But adding to what I already mentioned, and after hearing the DOF's proposal and arguments, which we fully understand, we wish to raise the fact that the less than 2% penetration rate of the insurance industry in the Philippines is the lowest amongst our ASEAN neighbors and the world. We have been supporting the government's call to narrow the protection gap and increase insurance penetration, but the biggest roadblock that we face is the tax on insurance products, specifically non-life, which disincentivizes the public from purchasing insurance. Other countries incentivize people to protect themselves, while in the Philippines, in effect, we disincentivize our people from insuring themselves. And this is very important given the fact that the Philippines, for the third straight year, has been identified as the most vulnerable nation to natural catastrophe events, which everyone is aware is increasing in number and ferocity given climate change. The industry needs guidance and a clear signal of where we would really want to be. We do, however, support the House bill in question. Thank you, sir.
When you say cost, Mr. Michael, you're pertaining to the DSTs.
We refer to the whole tax, sir, but the DST plays a big role, of course.
Okay. And right now, the regime of the non-life insurance companies are 12%. No? They're being charged VAT, and then there's also DST.
Yes, sir.
And
there are other taxes. For
like-
property, it would be a total of about 27.5%.
what are the other taxes?
You have local government tax,
the
you have
local,
fire
yeah.
service tax, etc.
Okay.
All adds up.
And then which is the biggest component among the 25%?
Well, it would be the documentary stamps for one.
All right. We'll talk about that later on. And then I was asking si Attorney Refran about the role of the insurance sector to the capital markets. Can you share us your thoughts on that aspect?
I fully agree with Attorney Refran. I would confirm that. But this is true mostly for the life insurance industry because they have longer term. In the non-life insurance industry, we're very much regulated by the Insurance Commission, and even our investments have to be vetted by the Commission. So ours is mostly short-term, and we have to be very liquid.
Normally, where do you
Government
invest?
securities,
Normally,
more
government
often than not.
securities.
Yes, sir.
Okay. And how many % of your portfolio is under government securities?
Well, it really depends on the individual insurance company. But to hazard a guess, it would be a majority, sir. Maybe
90
70, 80%.
70-80% government securities. And then the rest equities. Is that
Yes, sir.
safe to say that
Safe to say.
the rest of the pie goes to equities, the equities?
That's
part?
right.
And then also in the I know in the House proposal they made some really drastic reforms. No, I think you've read that. But the offshoot of that will be a massive reduction in government revenues that you saw earlier. There's another proposal, or the original proposal of reducing it to 7.5%. Any opinion to that? Is that a good middle ground that can? The objective here again is to increase penetration rates, no, and grow the market, so to speak. So hopefully by reducing friction costs to 7.5%, do you think that can achieve the goal of expanding penetration rate?
Well, to be honest, Mr. Chair, any reduction would be welcome. However, we are trying to narrow the protection gap, and even with that reduction, we're still going to be one of the highest taxed within our ASEAN neighbors, for example, or the world. But definitely any reduction from the present situation would be very welcome. But we'd like to point out that, yes, the Philippines is the most vulnerable country. We're trying to come up with cat protection. And when we go into the foreign market for reinsurance, our reinsurance premiums are very high as well. So there are friction costs all over the place. And any reduction would be very helpful to the insuring public.
Then you mentioned earlier that our tax rates among the non-life industry is one of the highest in the world. Do you know what are the others? What are the tax rates of the other jurisdictions?
We presented this in a position paper earlier,
Okay.
but I don't have it with me right now. But for example, within the ASEAN region, other countries like Singapore would have 2%, others would have 10%, while we have the 27.5%. But I can come up with I can supplement our position paper with a comparison.
I'm looking at a research study by NTRC. Oh, no, this is a position paper ba ito? This is a submission by NTRC dated January 28, 2024. Can we flash this para makita ng we have this? We'll just flash it. But it's a comparison of non-life insurance policies and products. For example, in Brunei, there's no VAT. And there's also no VAT-like or other business tax. And then the DST is 0.10%. Cambodia's also the same, no VAT-like impositions. Malaysia, it's the same. So I think you're on point in saying that we have one of the highest in terms of tax imposition. So I'll flash that later on. In Singapore, they have 9% VAT, 9% VAT-like imposition, but no DSTs. No? So looking at just a cursory look at the chart, it seems like the Philippines has one of the most highest, no, yeah, in terms of tax imposition.
Sir, if you also compare that to the fact that we're the most vulnerable nation to NatCat events.
Go
And
down.
well, we should also keep in mind that the government is the insurer of last resort. And the private sector is offering its capacity to help the government cushion that blow. If only the insurers, or I mean the insuring public, would be incentivized to purchase protection, insurance protection.
Let's go down on the slide. There, yeah. So Brunei, zero. Those, no, you can see the imposition. There's no imposition of Brunei except for DST. Cambodia, Indonesia. Indonesia, there's also no VAT. This is from NTRC. Who's the Tama, this is submission.
Mr. Chair, so far that's the latest taxation of the ASEAN region.
Okay. All right. There, and then you have Singapore. They don't have DST. So again, no, I haven't really come up with the effective rates, but seems to me we have one of the, compared to our ASEAN neighbors, we have one of the most taxed non-life insurance sectors. Because sa atin kompleto from VAT-like impositions to DST. No? Right. Any comment, NTRC, on this?
Mr. Chair, although we agree that non-life insurance companies are really heavily taxed compared to the life insurance, but we also need to take into consideration that the other taxes goes to the local government, and another one on the fire insurance is for the Bureau of Fire Protection. So technically, the taxation that directly go to the national coffer is the VAT and the DST.
Right, thank you for that. Thank you, Mr. Relosa. Do you have anyone from the life insurance sector? Do we have any? We invite Comsec. Did we invite? Wala, I know. Nah, but later on, we'll talk to the sector first. We don't have anyone from the life insurance sector. We'll ask the HMOs. We need sector and HMO. Any comment on the discussion and on the bill? Mr. Christian Argos.
Yes. Thank you, Honorable Chairperson Senator Gatchalian, and to members of the committee. Thank you for inviting us to give our comments. I do apologize we were not able to submit the position paper. We were informed of this hearing late last week, but if the committee allows and if the chair allows, we would like to submit one by tomorrow, Mr. Chair, to articulate all of our comments. Generally speaking, we support House Bill 9277. HMOs provide a vital service to Filipinos, but unfortunately, currently it's predominantly corporate market for us because of the premiums involved. And unlike life insurance and non-life insurance, our service is used by almost everyone that has an HMO policy. If you're covered, on average, you use the services 5 times a year. So you get the consult, you get outpatient care. And our contracts are limited to 1-year contracts by the Insurance Commission. So we don't have any long-term contracts. We don't have any long-term positions on investments to really fund our liabilities. So I think our comment here, Mr. Chair, is that right now there's an asymmetry in taxation between life insurance companies that offer HMO-like services and HMOs. For life insurance companies, for example, Coco Life and Etika, they get charged premium tax, whereas HMOs we have to impose value-added tax on our clients. And this is even more apparent when you look at the individual market. Because at least when you're a company, then perhaps you have some input tax, no? Input VAT and output VAT offsetting. But what limits the affordability as well is from a retail perspective, VAT is imposed on the service, and moving it to 2% tax would make it more affordable. The average premium for an HMO plan is about 18,000 pesos. If you go corporate, of course, we're trying to hit lower price points. But we do feel that at least leveling the playing field with non-life would allow HMO companies to roll out more affordable products and allow individuals to invest in their care, and also to decrease the government funding on healthcare. For example, Mr. Chair, if you look at PhilHealth support values for a typical HMO member prior to the pandemic, the support value of PhilHealth is around 12%, meaning they only fund 12% of the total healthcare spend per year of a typical HMO member. This year, as of 2024, that PhilHealth support value has dropped to 5.6%, meaning the individual covered by the HMO is funding most of their healthcare, and we want to make that more affordable also, so that the government can allocate resources to other areas. No? And it's also important for individuals to have a share in their own healthcare expenses, so that they have skin in the game in managing costs. There's also, sir, an initiative by the DBM and the Department of Health and the Insurance Commission to explore allowing government employees to purchase HMO products. I think the proposed budget is 7,000 pesos per head, and imposing VAT on that, it's just like, as you mentioned, Mr. Chair, from one pocket to the other. So we feel that this is a step in the right direction. Our comments would simply include clarifying and really being explicit in stating that HMOs are no longer subject to value-added tax. The additional taxes on DST we feel are not material at this point, because they're on a per policy level, and they're already capped at 200 pesos. That's something generally that HMOs don't currently collect, because we don't issue policies, but depending on the interpretation of the law, we may be subject to that. But we do feel that this is something that the industry will support. I'm also the chair of the Philippine Association of HMOs, so we have a common position on this, Mr. Chair. And my last comment is there's still an unnumbered substitute bill going around in the House of Representatives, focusing on the establishment of a Center for Managed Care Services to promote HMO penetration. And they have a similar provision, transitioning HMOs from VAT to 2% premium tax. And even in that hearing, Congressman Salceda, I guess, discuss a possibility of removing taxes altogether, again, in consideration of really promoting the participation of the private sector in funding universal health. Thank you, Mr. Chair.
So the conversion from VAT to premium tax will be beneficial to the pre-need industry.
Specifically for HMOs,
For HMOs.
Mr. Chair, yes, we believe it will be beneficial, not just to the industry, but for Filipinos who want to buy HMO services, out of their own pocket, not as a benefit provided by their employer. What we have observed, Mr. Chair, is that the employers have a fixed budget for HMO, and because of medical inflation the past 2 years, which has exceeded 20% year on year since 2022, the amount of resources allocated for HMO services by the employers not keeping pace with cost. So there's significant appetite for employees to actually co-fund additional coverage, to increase benefit limits and to cover their dependents, whether they be the parents or immediate family members. So this will really promote that and accelerate, the penetration of HMO services. Thank you, Mr. Chair.
How much will the price go down once we convert that into premium tax? Just ballpark figure lang from the point of view of the applicant, a person who will buy HMO.
For example, sir, we have a product that's 10,000 pesos for consumer. So then we add VAT to that, so 12%. So easily over 1,000 peso reduction on an annual basis. And Mr. Chair, the role of the HMO is to consolidate. Basically, we're a consolidator of healthcare spend. So we drive the unit cost down. And the margins in healthcare are very small. So all the effort that we do to decrease the cost by group group buying, so to speak, is already eroded simply by the value-added tax component, at least as far as the consumer and retail segment is concerned. So it's tough for us to add value there, Mr. Chair.
In terms of involvement in the capital markets, is your sector also involved in, let's say, investing in the equities market, in the bond market, in the debt market?
Yes, we do also invest, but because we have short-term contracts, predominantly we're in government securities, not really government securities, rather time deposits with very short tenors. In fact, minsan 30, 60, 90 days because we have to remain liquid. Again, our benefits are paid out on a very, very regular basis. On average, the loss ratios, if you look at the market the past 2 years, we've been hovering in the mid 85% level for loss ratios. So for every 100 pesos we collect within the same year, within the 12-month period, we give it out as benefits to our members.
Thank you. Thank you for the comments. We'll call on other. We'll call on our other resource speakers. We'll start off with TMAP, Attorney La Forteza. Any comments on the proposed bill?
Thank you very much, Mr. Chair. And thank you for giving us the opportunity to come here. Unfortunately, we have not yet submitted our position paper because just like the other resource persons, we just received the copy of the House bill late last week. And so therefore, we're asking for an opportunity to submit our position paper perhaps within the week. We're currently circulating the House bill for comment of the other members. So we hope you'll give us a chance to submit our position paper. However, I think my colleague here, Director June Meneses, has actually had the opportunity to study the House bill since it was introduced, I think, a year ago. So maybe I'll turn over the table to June.
Attorney Meneses.
Good morning, Mr. Chair. So probably some notes that we have in respect of House Bill 9277. If you look at the bill, and this answers your question earlier why it doesn't have the capital markets SIMEPA, because there's an earlier bill. It's House Bill 8958, which was substituted by 9277, which was the original SIMEPA bill. And in that bill, it was actually limited in scope. There were only 3 provisions of the tax code that were proposed to be amended by the House in respect of that original bill. We support the position taken by the Philippine Stock Exchange. We note that, yes, it will have a multiplier effect if the friction cost on the secondary market will be reduced from that 0.6% to the 0.1%, which is the primary, I think, the primary provision in the SIMEPA, which should be taken into consideration in terms of its importance in respect of creating that multiplier effect for the capital markets. There are a number of provisions that are also secondary. It's just a question of determining whether it's really a direct or indirect effect on the capital markets, and basically that's it, sir. As VP Karen mentioned earlier, we would be submitting a position paper in respect of the SIMEPA, and but we had just one last note. We do agree with you, Mr. Chair, that we had a very long discussion on PIFITA. In fact, a lot of the provisions that are being discussed now are provisions that were already discussed in PIFITA. And we just like to probably ask a question whether the discussions that were made in PIFITA would also be taken into account in looking at SIMEPA. Because a lot of the things that were being raised now in terms, let's say, for the HMO, because if I look at SIMEPA, the current version that's under consideration right now, there is no amendment to Section 183, which was the primary, I think, provision that was being asked to be amended by the HMO in terms of the DST on HMO products or HMO insurance. So we think that probably many of the discussions in PIFITA should be taken into consideration in terms of SIMEPA, and some of the things that are needed to be included or excluded from SIMEPA.
Well, definitely, Attorney Meneses will take into consideration the discussions. We had a long technical working group sessions during those times, and we will definitely use the transcript as the basis for further rehashing this proposal. This proposal came to light because of two reasons. One, because of the LEDAC advice to us, and then number two, because of this transmission of House Bill number 9277. So we deemed it necessary to conduct another hearing just to consider this bill, and later on we'll further refine it and use the discussions earlier in its refinements. Thank you. We'll call on TMAP, represented by Ms. Attorney Perez.
Good morning, Mr. Chair. I'm representing the Management Association of the Philippines. I'm also a member of TMAP and also Phoenix Capital Markets Committee, whom I understand they were not invited, so hopefully they'll be invited next time. Number one, Mr. Chair, we support a fast, an expeditious passage of the bill. So we appreciate your effort to compartmentalize the issues or simplify the issues so that the bill will be passed. Number two, we support anything that reduces the friction cost of the capital market. We support the stock exchange wholeheartedly on this. We have been working, especially also in Phoenix, Mr. Chair, the Capital Markets Committee there. Really, we are really working on or studying or supporting anything that will improve our capital markets. So we will support the immediate reduction of the 1%. And maybe to address the DOF concern, that's why my question earlier, if we could just make the bill palatable also to the DOF so its passage will be assured, then we will support that, Mr. Chair. And we also support any support or reduction of the taxes to the HMO market. I am an employer myself. I have HMO myself, and because of our poor healthcare, unfortunately, of this country, HMOs are very important for employees, us from corporate point of view, but also, Mr. Chair, also from the individual point of view, we should encourage retail purchase or retail subscription to HMO products, because healthcare is very expensive in this country, and we should work hard at supporting our people getting the proper insurance and coverage, because I don't think the people has the mindset of covering themselves. We are so fatalistic when it comes to health and life, but it really helps a lot that our people, the retail, not just even the employees, are able to afford HMO coverage, Mr. Chair. That's even on a personal note. Thank you.
Attorney, you're amenable to carve out the capital markets provision in PIFITA and make it a standalone bill so that we
Mr.
can
Chair,
push it faster.
if it is the objective, your objective to a faster passage, and as long as it's a little bit, it will send a very good message. Mr. Chair, I am for the PIFITA. Please don't take me. We support the harmonization of all these taxes. I know extensive discussions have been had on that. I support the simplification of the taxation. But in reality, if we need to simplify the bill so that it will be passed this Congress, then we wholly support it. Then we would support the immediate reduction of the stock transaction tax, because I think that will be a very good story to tell, Mr. Chair, and it will be very dramatic. And I think it will justify the carving out of the provision. But we still, as MAP, as Phoenix, we support the PIFITA, Mr. Chair. Please don't take me.
In our internal discussions, we actually the plan is to pursue this SEMEPA because as what the Attorney Refran mentioned, it's a quick win for the country because it's simple and easy to understand. And then we will still pursue PIFITA, to harmonize all the different tax rates after SEMEPA. It's just my fear is just the time, because the country is going into an election year next year, and we all know that things go slow during an election year. So that it's really the time that we're looking at. But in terms of objective, we want to approve both bills, hopefully before the 19th Congress ends.
Thank you so much for that. We really also support the PIFITA, Mr. Chair.
And from TMAP's point of view, from
MAP.
MAP's point of view, do we in the promotion of the capital markets, based on your studies and also consultation with your members, should the insurance industry be part of the capital markets promotion?
I cannot answer that, Mr. Chair. But for me, anything that supports the insurance, whether life or non-life, would be good for the country, Mr. Chair.
All right. Thank you, Attorney. We'll call on TOAP, si Attorney Recalde or si Miss Beltran. Yeah. Anyone from the group?
Maybe I can begin, Honorable Chair.
Yes.
So thank you very much for your invitation. The way that the trust the trust entities participate in the capital markets development is really in mobilizing funds, both from retail and big investors, and investing these funds in several asset classes, debt, equity being among those. What we notice though is that there's predominantly preference predominantly for fixed income, because there is very little I guess the financial literacy is not at its peak yet in the industry, at least in the markets. But we do acknowledge that it is in that space where investors can get premium earnings, and so we normally encourage, especially now with the market turning around, investors to go in that space. So we have, if you will look into the composition of all assets under management under the trust industry, I think a strong third represents investments in equities. A third of that. 2/3 would be in your debenture, in your bonds, etc., etc. The way we would want it to be though is for investors to really take on more equity so that they can participate in capital developments. But this has been quite hard because like I said, literacy is not at its finest here. Now we do have a second another portion of the AUMs we manage represent pension funds, funds coming from government entities like the GSIS or even the SSS, which we manage now, and even funds from the insurance industry. So we manage also funds coming from pre-need companies. As you know, the law requires that a portion of their premiums be put under a trust fund. So we manage all these funds all together. And what we notice that for most of these types of clients, equities is really an area where they like to generate premium returns. So so that's how we participate in essence in the building of capital markets. We have already submitted to the committee our propositions with regard to the PIFITA. I will allow Attorney Ricalde to take on that.
Yeah, go ahead, Attorney.
Good morning, Mr. Chair. Just to affirm that TOWAP is for the support the reduction of the friction costs in the capital markets and also in the CAS. TOWAP is also for the harmonization of the taxation of all types of the CAS. And TOWAP supports the small PIFITA and also the big FIFITA, subject to the clarifications that we highlighted. But up to a certain extent that CEMEPA will be given preference. Just to allow me to give some comments on this small PIFITA, because to the extent that this includes CIS in the definition of the shares of stock and the definition of collective investment schemes, we take it to mean that the definition only pertains to the Section 127 definition on the stock transaction tax and has nothing to do with the documentary stamp tax. You will recall, Mr. Chair, that this small PIFITA does not touch on 174, but we do not want this implication that assuming that the big FIFITA does not push through, BIR will start to collect the doc stamps on the CIS that's being administered by the trust, because you will recall that the UITFs in particular right now are not subject to DST because they don't issue shares of stock. Effectively, these are mere participation. Functionally, they're different from shares of stock, and up to a certain extent that they issue these certificates of participation, the funds are invested in investment instruments that are subject to DST. We don't want multiple DST in this regard that will even somehow discourage the development of this UITF market.
To Attorney Recalde or to Ms. Beltran, what is the role of I'll talk about CIS in general, no? Because definitely we all know UITF is part of the CIS group. What role does the CIS perform in terms of developing the capital markets?
I think, Honorable Chair, it's really allowing the retail investors to participate. Of course, that has changed over the years, but way back when UITFs were introduced, the minimums to deal with broker or buy bonds in the bank would amount to 200,000 to maybe even 200 to 100,000. But with the introduction of UITFs, investors could now come in with a measly 1,000 pesos even. And that's participating not just in fixed income markets, but even in the equity markets. But what's even better is that through the UITFs, what we have afforded retail investors is the skill and the experience of a fund manager in the person of the trust entity. So I think this is critical because what the UITFs have allowed is the selection process. We have introduced a scientific way to selecting what should go into the fund in terms of the assets, the the stocks themselves. So that is what the investor actually pays for. It is the knowledge, the know-how, and the ability to put together and combine all these investments. So it's really for the UITFs were created really to give access to the retail investors, sir.
Investment goes to capital markets, instruments in the capital markets. correct?
Yes,
Like, for
definitely, sir.
example, stocks, bonds, those type of instruments.
Correct. And the BSP, however, very clearly said that in the regulations governing UITFs, that investments within UITFs should be in tradable securities. So that's very clear in the regulations by the BSP. Only in tradable securities, securities that are listed in most cases. So these are the limitations of the UITFs now, right now, with regard to the BSP regulations.
It's in other words, the nature of its business is directly involved in the development of capital markets, because you encourage people to buy units of participation, and the accumulated funds will now go into different investments. no?
Correct.
Primarily because of the requirement for liquidity or tradability, then obviously equities market will probably be the first beneficiary of that, because it's traded on a daily basis.
Yes,
Yeah.
you are correct, sir. Equities also being alien to the retail investors, they would prefer to do it via professional funds such as the UITFs. So it actually gives the retail market a taste of what it means to invest in the stock market.
Same for mutual funds as well as VULs.
Yes, except for the VULs, there is a component
Yeah,
of protection.
Yeah,
Yes,
correct,
yes.
correct. But the outside of that protection, it operates the same as a UITF or a mutual fund, that it go invest in stock market and in the equities market, as well as in other tradable asset classes.
That is correct.
All right. Okay. Thank you. And Attorney Ricardo, you mentioned earlier that you support the harmonization of taxation of the different varieties of CIS. Can you just elaborate on that? No, because from what we understand, mutual funds, UITF, and VOLs, they all, although their objective is the same, but they operate, their nature is very different. No, so how do you how do you envision that harmonization?
That's correct, sir. In particular, UITFs, for example, vis-a-vis the VULs. Okay. For the UITFs, we're subject to the 20% final withholding tax on the yield upon declaration, whereas relative to VULs, upon their I would say maturity, the amount up to the extent that they're in excess of the premium paid are not subject to this 20% final withholding tax, but subject to self-assessment. So somehow it depends on really on the investor, the holder, to declare that, to report that amount. Unlike in UITFs, they are withheld at source. Now, we also understand that, let's say, from perspective of mutual fund companies is they're also subject to corporate income tax, but upon declaration of dividends, they are also an additional. Upon redemption, they're not subject to gains on that, because they are specifically exempt from income tax by from gains from the redemption of this mutual fund. So, in other words, it's possible that the mutual fund companies are subject to corporate income tax, but generally these are already subject to final tax because they invest in this passive income subject to final tax. So practically no corporate income tax paid at the mutual fund company level, and upon redemption, there's no more further additional income tax. Unlike in UITFs, there will always be that 20%. Although it's UITF is essentially a flow through, it's a revocable trust, and up to a certain extent that we also invest in the capital markets, certain items could be subject to final withholding tax as well. That's fine. That's already clarified. But those which are not subject to final withholding tax, we still pay that 20% final withholding tax in that regard. So we explained that in full. There are differences in treatment considering the structure, and somehow even on the doc stamps, Mr. Chair, we're fine with the application right now on the Section 188 on the DST on the certificate. And that's why I'm clarifying here that with the definition of CIS, inclusion of the CIS in shares of stock, we do not want any implication that the UITFs, the units, could also be considered shares of stock for purposes of DST under Section 174. Precisely, we tried to clarify this last time in the big FIFITA that even mutual fund certificates, VULs, and UITFs, they shouldn't be subject to DST under 174 because the DST functions as a tax on the execution of privilege, tax on the transaction. Unlike in an ordinary shares of stock, wherein it's more than some form of co-ownership, but there's an exercise of ownership in that sense, the right to vote, the right to receive dividends. A UITF holder, a unit holder, does not have this right. It's essentially more on a participation in the ownership of the funds invested in the investment outlets. So our position here is that we support CEMEPA to the extent that it reduces friction costs. It allows the UITFs are here to mobilize funds to provide bigger yield to the unit holders, but there should be less friction costs in the sense that there's no way that this CEMEPA should be interpreted to include units of participation under Section 174 for purposes of doc stamps.
Thank you for that, Attorney. The concept here is if we grow the CIS sector, in turn it will grow the capital markets sector as well, because the funds that go into the CIS, regardless whether it's mutual funds, UITF, or VUL, the funds accumulated from those investment schemes will end up in the capital markets. So in other words, what we need to do is to grow the number of investors going into CIS.
That's correct, sir.
And in that case, how do we because we're talking about harmonizing the rates, we're talking about even lowering the rates. Which portion of the CIS should be tweaked in order to attract investors to go into the CIS? Aside from harmonization, no? Because we're just harmonizing, meaning making it the same for the other schemes. No? But which one of the different tax rates we should look at or tweak in order to boost investments in the CIS space?
First, Mr. Chair, in general for CIS, there should be no DST, and that applies to all types of CIS, whether corporate or contractual. Let's say for mutual funds, there should be no DST on that because essentially it's like a corporate setup, but in reality, even the mutual fund holders, they don't they're different from the usual that ordinary stockholder that is subject to doc stamps under 174. So it follows same with VUL holders, CIS, and mutual funds. There should be no friction cost in that regard. After all these pooled funds, they're not just being held by this by the pool. They're also further reinvested, and up to the extent that there's that investment, there's already payment of doc stamps. So in that sense, that reduces friction costs. All these pooled funds, they appeal to the retail investors. as explained earlier by OWAP, we cater to the smaller investors. In fact, for certain UITFs, that's available even if a mere 50 pesos. 50 pesos, you can already participate, and that can be marshaled towards the investments in the capital market, Mr. Chair. So at least on the clarification that on the doc stamps, there should be no doc stamps on the CIS across the board
CIS level.
at the CIS level.
But when the CIS, when the funds buy, they buy equities or they buy other instruments.
That's fine, Mr. Chair.
There's doc stamps at that level.
That's fine,
Okay.
Mr. Chair.
All right. Okay. Thank you for that comments. Well, we also have some resource persons from.
May I ask something, Mr.
Yes, go ahead, attorney.
Then I'll ask Eric, what is your specific proposal to accept the CIS from doc stamps? What a provision of the tax code should be amended?
One way is to include in section 199 on the exemption, because if you look at section 22, this is definition under title 2, in particular income tax. It has nothing to do with, I think doc stamps is title 5 or like that. But the problem here, Mr. Chair, is more on the interpretation and regulation. So I'm saying under section 22, if it will be amended as proposed in the SEMEPA or the small PIFITA, since it can also extend to stock transaction tax, because stock transaction tax is in lieu of a capital gains tax, which is effectively a tax on gains, effectively, but should not apply to doc stamps. So to avoid any doubt here, there should be an amendment in section 199 on the exempt documents and transactions. The CIS at the CIS level. I believe, Mr. Chair, in the big PIFITA, we already proposed that. We have a proposal on that.
Thank you. Can we also hear from our friends from the Insurance Commission? Si Attorney Medina.
Good afternoon, Mr. Chair, and good afternoon to all those present. The Insurance Commission has previously taken a favorable position on premium tax reduction, as we view it as a way to increase the insurance penetration by lowering the cost. However, we are for also for equitable treatment of similarly situated sectors as far as practicable, including its comparative treatment internationally, more particularly in the ASEAN. But sir, we also defer to the position of DOF, as we have seen the negative effects it will have on our revenue. Yeah, thank you.
Any comments from the SEC represented by Attorney Fernandez?
Good afternoon, Mr. Chair. Thank you for inviting the Securities and Exchange Commission to the deliberations of the SEMEPA. Just like to manifest that, one, we support any measure that would broaden, deepen, and further develop the capital markets, and precisely why, upon benchmarking with industry and talking with with ASEAN peers and talking with industry, we have lobbied for the reduction of the stock transaction tax to 10 basis points. And we believe that, as earlier mentioned, that this will promote competition. This will further promote activity in the market, and of course, this will really result in a reduction of friction costs. In the same manner that the SEC has espoused or has launched initiatives to boost our capital markets, specifically our stock markets, through various regulations. And we believe that a reduction of the STT is one of those that will contribute in reducing friction costs. Just the same, Mr. Chair, we had recent discussions with the Department of Finance, and we were happy to have been informed that whether we go the route of the CIMEPA or the PIFITA, the STT has been incorporated in the proposed measures. Of course, we defer to the wisdom of the Department of Finance and of this committee, Your Honor, whichever will be most expedient, number one. And of course, taking into consideration the sustainability of any revenue measure that we will be pushing for. And just the same, Mr. Chair, we also manifest that we are one with the DOF in expressing support and assistance for any initiative that would allow us to maybe arrive at a version of this bill that is maybe at the very least revenue neutral and attain the twin objective of further developing our capital markets. Thank you, Mr. Chair.
Thank you, Attorney. Any comments? I saw in my list we have friends also from PCSO, although I made some comments already earlier. But any comments from PCSO and also from the Philippine Racing Commission? Meron ba? Yeah, we'll start off with PCSO
Yeah.
first.
Good afternoon, Mr. Chair. On the part of the PCSO, of course, we fully support the proposed bill, and it seeks to address two taxable items in our charter, and that the price on winnings, the reduction of 21st from 20% to 10% would be a good relief for our bettors. And for the DST, we are very appreciative for the intended reduction of from 20% to 10%, but subsequently the final proposal was increased to 15%. So whatever savings that we will be generating from the DST will be translated into the delivery of services. That's on the part of the PCSO, Mr. Chair.
Thank you. And to the Philippine Racing Commission.
Good morning, Mr. Chair. Good morning to our other resource persons. I'm Attorney Victor Angelo Tantoco, Commissioner of Philippine Racing Commission. And we would like to give our stand, although the position paper will be filed anytime within the week. But just to summarize our stand, we are only affected by sections 190, which talks about 20% that is by virtue of the train law that is imposed on any bet that is made with the Philippine Racing Commission. And at first, there are legislative franchise given to the racetracks, and they were given actually 10%. Just to give you a history on why I will have our stand. 10%. But however, upon the arrival of the train law, the DST was increased to 20%. However, Your Honor, the legislative franchise, which said that it should be 10%, the legislative franchise holders lobbied to GAB in Malacanang, and despite the train law, we were given they were given a go signal to collect only 10%, Your Honor. And this was through GAB, and it was approved through Malacanang. So it is the stand, Your Honor, of the Philippine Racing Commission that we have no objection to sections 190, so that it would harmonize the existing legislative franchise and what we are actually what is being imposed actually on the bets, Your Honor. So we would like to harmonize the laws, and we have no objection on this, Your Honor.
Thank you. You mean the Malacanang approved only the collection? How is that?
Your Honor, because
What is the legal basis of that?
the legal basis, Your Honor, the legislative franchise holders wrote to GAB, Your Honor, and told them they're actually MMTCI, Your Honor, is had their franchise renewed, Your Honor, in 2020, which provided for in their franchise that the documentary stamp tax, Your Honor, will be 10%. But despite of this, they were being collected 20%. So they wrote a letter to the Games and Amusement Board stating their legal grounds, Your Honor. And what the Games and Amusement Board Your Honor said, is that this is subject to higher approval from Malacanang, Your Honor. And we have and on March 2023, Your Honor, this was approved by the Office of the President, and that's when they collected 10%, Your Honor, after the approval of Malacanang, Your Honor. And this, Your Honor, we can provide for in the position paper, all the documentation, Your Honor.
Thank you. Yes, you can just submit it to us.
Yes, Your
Richard.
Honor.
Right, thank you. Any comments from the DOF family, aside from what Asa Carlo mentioned, BIR and TRC? Normally you have a unified position on this, but any comments from what you've heard so far from the discussion?
Mr. Chair, regarding the CIS, particularly on the DST harmonization and exemption of CIS on the DST, I believe before the proposal was to harmonize, but they will still be subject to DST. And hence the previous proposal was that they will be subject to Section 174. All of them will be subject to Section 174, except for VUL, wherein the life insurance component will be subject to 183. And then in terms of harmonization, all CIS will also be subjected to withholding. So there will be no more self-assessment. So I think those were the things that were agreed upon during our previous TWG, and not really exemption particularly on the DST of CIS.
My opinion, the CIS is very important in the discussion of capital markets because it's directly connected. All of the retail investors investing in those products will end up indirectly investing in the capital markets, in the stock market, or even in the bond market, no, if we have one later on. So in my view, that the CIS component is very important to include here in the CEMEPA bill. However, I'm thinking of ways, ASEC, how to encourage more investors to come in. No? Definitely, the goal is to harmonize. I think PIFITA's goal is to harmonize the whole CIS industry. But at the same time, I'm also thinking of how to attract more investors to come in. Of course, the knee-jerk reaction there will be lowering down DST or even eliminating DST, or harmonizing some of the tax rates across the different products. No? So, but the goal here is to get more people investing in CIS so that they end up indirectly investing in the capital markets.
Mr. Chair, one clarification. When we say exemption of all CIS on DST, does it include mutual fund?
Attorney Ricardo.
Mr. Chair, precisely. Well, on the harmonization, I understand that right now mutual fund companies, in particular on the mutual fund shares, are subject to doc stamps. But precisely, they're pointing this out, and there are a lot of variation in treatment across different types of CIS. Okay, so if truly we want to harmonize, and all CIS, including mutual fund certificates, should be exempt from the ST, because the amounts invested in the mutual funds are also invested in, for example, in these debt instruments or shares of stock. So just imagine you have 100 pesos. If it's already subject to DST at the CIS level, and that same 100 pesos will again be invested in another shares of stock, there will be due to DST. So that's why if we want to harmonize the treatment for DCIS and encourage the mobilization of these retail funds, we should exempt that at that level. After all, we can differentiate the CIS holder from an ordinary shareholder. They don't typically have this attend shareholders meeting like that, because after all, that's only a scheme to mobilize funds. Unlike an ordinary stock corporation, they function totally differently, Mr. Chair.
For UITF and VUL, because
For-
the issue
For your,
is a participation, di ba, in this case.
yes, Mr. Chair, but for UITFs, they are revocable trust. It's like a flow through.
And they're exempted already from DST, right?
They're not considered shares of stock under the
Okay.
existing regime. And to the extent that they issue certificates, they pay DST under Section 188 and not under Section 174.
But they will also be exempted. If mutual funds will be exempted, that part is also, the proposal is to exempt.
Yes,
Tama?
yes, of course.
Proposal lang naman to, Proposal lang.
Right,
I'm not saying.
right now, Mr. Chair.
Because the question is how to get more investors, diba?
Yes,
So it's that
precisely.
question.
Yes, Mr. Chair. Right now, UITFs are not subject to DST under 174. And I am seeking clarification precisely with this small PFITA up to the extent that this includes in the shares of stock definition, CIS, and it has nothing to do with Section 174 definition. We don't want any implication that come the implementation, assuming there's no big FIFITA explicitly exempting this CIS, here comes BIR saying that even UITFs are now subject to DST under Section 174. Precisely, that's not the intent. And in my opening statement earlier, if we include DST at the CIS level, this will increase friction costs in the mobilization of funds. Hence, our proposal is totally to remove DST at the CIS level. If up to a certain extent that will even remove DST on the mutual fund certificates, that we likewise support, Mr. Chair.
VULs, they have at the CIS level, do they have DST?
There's none, Mr.
Wala,
Chair,
no?
because they already pay premium tax.
Premium tax, oo.
But that's only up to the extent of 200 pesos. It stops at 200 pesos.
We don't have any representative from the life insurance group here, but let me ask Insurance Commission, the investment portion of the VOL, can that be, we had a discussion on this during the technical working group, but I want to put it again on record for this particular discussion. No? Because right now, when you invest in a life insurance with the VOL, everything goes to, not everything, but it's your charge premium tax, but a portion of that goes to investments. No? But is it possible to segregate the investment portion?
Mr. Chair, as previously discussed in one of our position papers on the CIS bill, we are of the opinion that the insurance portion and the investments portion of the VUL cannot be segregated.
How do you tax the investment portion? What tax regime does it undergo?
It's as previously discussed by Attorney Recalde, it's under the personal income of the policyholder, sir. He will have to declare it in his income tax.
Okay. I remember during a technical working group, I think it was the BIR who, tama ba, Attorney Reyes? I think we had a long discussion on that. And apparently, in the books of the life insurance companies, it can be segregated. It can be pinpointed which amounts go to the investment portion and which amounts go to the insurance portion. That's how I understand it during the technical working group. Tama ba, Attorney Reyes?
I think
I think you were there that time.
yes,
I
at
remember.
first they were claiming that it cannot be severed, but later on during the discussions, it can be shown that it can be severed. What component goes to the life insurance and for the investment aspect.
That's what I remember. We'll review the transcripts again, but I remember that for tax purpose, this is only for tax purposes. No, it can be pinpointed.
Yes, Mr. Chair. Like what we also said in our position paper on PFITA, we are okay with treating VUL as CIS for tax purposes only. But then from what I understand on what VUL is, it can be paid for one-time payment only. There are different products. There can be 3, 5, or 10 years. And for each year that you pay a certain amount, a portion of that goes to your life insurance, while the rest goes to your investments, the investments portion. But then after you have paid the whole amount, for example, after you have paid for 5 years for a 5-year term VUL, you will not be required to pay another amount for each year. But then the insurance company will have to take from your fund value the value of your premiums for the current year. So that's how it works.
We'll review the position paper you sent, and the goal here is to harmonize the different varieties of CIS and also to prevent arbitrage between the different products. No, so that's what the goal is. No, and we'll review the position paper that you sent on VULs, specifically on the taxation angle.
Thank you, Mr. Chair.
Mr. Chair, I believe we submitted a comparative table on that precisely on that special session.
Okay, thank you for that, Attorney. Any more comments from the body regarding House Bill 9277 and its goals? If there's no more, yes, go ahead, Attorney La Forteza.
Thank you, Mr. Chairman. So maybe just one last question, and this also goes into Attorney Recalde's comments, because we noticed that the CIS definition is actually not in any other portion of the tax code, but it's in section 22, which is under Title 1, no? Which is income tax. So our question, and I think I shared this with Attorney Mata, is what is the purpose of putting it under income tax? If we say it's a share of stock without amending the other portions of the income tax title, are we in effect going to treat, transfers relating to it just like transfers of shares of stock? So maybe we just have to check what the implication is. Would distributions out of the shares of stock be taxed just like dividends? So maybe that's our question. So it's more a technical drafting question, because we've been discussing how we could make CIS attractive to everyone. But if we start treating it as a share of stock, then distributions to the holder will actually now be subject or maybe taxed just like dividends. And if I am somebody who's investing in CIS, I'd be taxed twice, right? Because the CIS invests in passive instruments which would already be subject to income tax or a final tax. And then when I receive the money, I'd still be possibly subject to another tax. So it's better for me to just invest directly, right? Because I wouldn't have a 20% on 80%, which is already net of the 20%. So maybe if we could also consider the reason for the definition or the amendments in the definition of the shares of stock. And I note that maybe this was something that was already discussed in the big PFITA, but there were also other amendments that were introduced in the definition of shares of stock, one of which I think is depositary receipts, right? So we have to be very careful in amending these definitions because they have an impact on the taxation of these particular instruments. So yun lang po, Mr. Chair.
Mr.
Yeah,
Chair,
go ahead,
I share
Attorney.
because listening to all of this, my question was really, what is then the benefit of including CIS in the definition of shares of stock? And I think to add to Karen's point of view, it's not just the distribution, it's also probably the transfer. Because shares of stocks, we have specific rates for transfer, capital gain stocks of 15%, we have doc stamps also. So it really has a effect on the other sections of the tax code. So we support, Mr. Chair, the CIS as an instrument because it's a way of encouraging retail investment into the capital markets. We should also just, because I think we heard earlier that what we really want to improve is the retail investment, because that was also to encourage savings by our people. And therefore, any amendment to the CIS should not deter people from investing into these types of instruments, Mr. Chair. Thank you.
For those comments, and definitely we'll review the definition and the impact of the inclusion of. There's a lot of things that were included: depository receipts, ETF, exchange traded funds, CIS. So we'll review that as we go along. Yeah.
Mr. Chair, I'm just looking at the small PFITA on the CEMEPA. The inclusion of the term CIS really is to benefit the investor, in particular in the capital markets, because in the definition of shares of stock, there's an amendment under Section 25, in particular the reduction on the dividend tax by the non-resident individual from the standard regular corporate income tax to just 10%. That aligns with the usual dividend tax to an individual resident Filipino citizen. So in that sense, it's a plus. And in relation to the stock transaction tax, I could see, given the totality, that the inclusion of the CIS definition, that could also reduce the stock transaction tax to 10 basis up to 10 basis points, in the extent that even the contractual CAS, usual, I understand that's the ETF, effectively it's a contractual CAS, that's also the benefit, it's a plus. But what we want to avoid here is the negative, the unintended consequence if we fail to clarify the inclusion, the effect of this CIS inclusion in the definition of shares of stock, in particular on the doc stamps, and as mentioned by Attorney Lafortes and Attorney Uni Perez, including the subsequent trading. For the UITF type, they don't declare dividends, so it's not an issue. But for the other CIS, there could be implications, and precisely there will be a bigger impact the moment we try to dwell on the harmonization of all these CIS treatment, and as this lengthily discussed during our big PFITA session. So again, if the intention really is to focus on the CEMEPA, okay, at least on the doc stamps, it should be clarified that at least for TOWAP, for UITFs, they should be specifically exempted from doc stamps under Section 199 to avoid any implication that the inclusion of CIS as shares of stock would give rise to any implication that 174 is effectively expanded as to the coverage that would include even VULs, for example, and also UITFs to be subject to doc stamps.
Thank you, Attorney Ricalde. Attorney Refran, I want to get your comments on the role of CIS to the equities market and your experience on that aspect.
Yeah. Thank you, Mr. Chair. I remember before there was under the House Committee on Econ Affairs, I think this was during the time back in 2015, Mr. Chair, there was a CIS bill. But in particular to your question, the collective investment schemes, to the extent that they are listed, they do provide for, let's say, diversification benefits. That's really the come on when you look at the CIS in the nature, let's say, of a listed mutual fund. And in our space, Mr. Chair, that would be an exchange traded fund. Whether the underlying would be bonds, there are also exchange traded notes. or an ETF structure would normally be underlying an equity. So whether it's bonds or equities, as long as it's exchange traded, that really partakes of a security that anyone can, I would say, utilize for diversification, regardless of whether it outperforms the market or not. But if it's not listed, that's really an investment mechanism for them to pool capital. It's really a pooling of interest. It's still a security, Mr. Chair, under Republic Act 8799, because expectation there is primarily profit-driven under the Howey test. I'm just not sure if on the secondary market, if there is a secondary market for that, because the definition of a market under our framework of securities laws is that there are set rules for people to buy and transfer it, and it's not the issuer that would be transferring, but really the unit holder. And that would be either an over-the-counter market, particular to if it's duly registered with the SEC, or an exchange, which is also a different creature under 8799. So to the extent that there's secondary trading in the market, whether it's over-the-counter or a public market, as we call it, the lit market, then that might fall within the purview of, let's say, a Section 127. Otherwise, Mr. Chair, there's no secondary market for that because I am theoretically returning and I'm demanding a return from, let's say, the one that pooled the investments.
Pooled funds. Does it enhance the development of the capital markets? Does it enhance the development of capital markets?
Oh, yes, Mr. Chair, because they are able to have access through their own network for purposes, let's say, of the banks. Normally, this would be the entities, the trust entities, whether within the bank as a or spun off. There are trust entities that are corporatized, spun off, or they might be compliant also even if it's within the bank. They're able to tap through their asset management arm or the private wealth, especially. The private wealth is a very big business, as we have a lot of competition from the regional private wealth. And we've seen this as of the last 10 years, Mr. Chair. And it's something that I think the domestic private wealth business will really have to put up very attractive products. It's all about the attractiveness of the product, Mr. Chair. You may have the network, but the home offices would family offices rather would still be happy to repatriate external repatriation. So they do help us a lot, Mr. Chair, because especially for the family offices would probably be main targets of the private wealth. And the big family offices, the regional, are the ones that actually look for jurisdictions where on a friction cost basis, they're very competitive. So we're probably looking at intergenerational wealth here that could be allocated to the equities or the bond markets, but more on the equity side, Mr. Chair, because their return expectations are from a perspective of IRR are very high because this is intergenerational wealth. So they do provide a lot of dry powder again to the market. But if it's structured, let us say, Mr. Chair, as a CIS, especially on a long-term basis, I think it's really very beneficial to the capital markets.
Data on how big the CIS market, how big the CIS market invests in the stock market? Do we have that data?
We'll get that, Mr. Chair, from our network.
But from your estimate, is it how big is that pool of funds that goes into the stock market?
Maybe, Mr. Chair, yes, Mr. Chair. On a daily basis, we have around roughly 80% being given by the institutionals. The retail accounting for 20%, although during COVID, we saw an uptick to around 50% for the retail. So out of that institutional 80%, Mr. Chair, it would not be surprising if the collective investment schemes would account for half of the 80% because these are their mandates really is to make sure that they deliver on their representations in their term sheets. And customers and retail investors are very picky also nowadays if you are underperforming the market. Given the opportunities available, the switching costs are very low right now, Mr. Chair. So it's the substitutability aspect of this and demand is very elastic. I would say it's not an inelastic demand here just because I've been your loyal client. I could readily switch, Mr. Chair. So they do participate a lot in our trading activity.
Yeah, so it's a very important a source of funds for the capital markets, in other words, no? Short.
That is correct, Mr. Chair, from our perspective.
Yeah, thank you. Ms. Beltran?
To offer some statistics, Mr. Chair. So I think in the BSP report as of June, the total assets under management of the trust industry is like 6 trillion. Of that 6 trillion, a third is into collective or UITFs. So divided across fixed income UITFs or equity UITFs. So to give some numbers into how big the market is.
Ms. Beltran, just submit to us that those data, the more current, the better, and the more detailed, the better, so that we can use that during our defense of the bill. Right. Thank you. All right. So, any more comments regarding the measure?
Mr. Chair, I would agree with the assessment of our partners with regards to the taxation of CIS and its implication in terms of the amendments under Section 22 of CIMEPA. If you remember, Mr. Chair, we have several amendments in Package 4 in terms of the taxation of the CCIS, and we made sure that we harmonize them. So we agree with that assessment that this may have unintended implication in terms of the taxation of CIS if we will not amend this particular Section 22.
We'll definitely discuss that as we move along the bill. So if there are no more discussion, no more comments, again, thank you very much for your time, and feel free to send us your position paper on this bill. I know that you sent us numerous position papers on the big PIFITA, as we call it, but feel free to send us your position paper and data. As you can see, we use the data when we defend our proposal, and the more robust, the more detailed the data is, the better for us to present it. So thank you very much again for your time, and we'll suspend this hearing until, and we'll have another round if necessary later on. So this hearing is hereby suspended. Thank you very much.
Recording stopped.